Expert SEM, Supply Chain and Allied Domain Knowledge Sharing session. In this session, let us see a term called terminal value or TV in short. Terminal value is a value of an asset, business or project beyond the forecasted period when future cash flows can be estimated. Terminal value assumes a business will grow at a set growth rate forever after the forecast period. Terminal value often comprises a large percentage of total assessed value. Forecasting getting murkier as the time horizon grows longer. This holds true in finance as well, especially when it comes to estimating a company's cash flow well into the future. At the same time, businesses need to be valued. To solve this, analysts use financial models such as discounted cash flow along with certain assumption to drive total value of a business or a project. Discounted cash flow is a popular method used in feasibility study, corporate acquisition, and stock market valuation. This method is based on theory that an asset's value is equal to all future cash flows derived from that asset. These cash flows must be discounted to the present value at a discount rate representing the cost of capital such as the interest rate. DCF has two major components, forecast period and terminal value. The forecast period is usually about 5 years. Anything longer than that and the accuracy of the projections suffer. This is where calculating terminal value becomes important. There are two commonly used methods to calculate terminal value: perpetual growth and exit multiple. The former assumes that the business will continue to generate cash flows at a constant rate forever, while the later assumes that the business will be sold for a multiple of some market metric. Investment professionals prefer exit multiple approach while academics prefer perpetual growth model. Thanks for watching. Bye.